Hi everybody, this is Lara with your end of the week analysis for the S&P 500 for the trading week ending Friday 19th of November 2021. I have a new target for you, 4777. I am calculating a lower target for you because there is increasing bearish divergence between price and breadth and price and inverted VIX. And so it looks like there may not be enough strength in this market to reach those higher targets. We may need a closer target. Let's have a look at the Elliott Wave analysis first, classic analysis last as usual. My Elliott Wave count sees a fourth wave at cycle degree over at this sharp brief bear market ending in March 2020, and there a bull market resumes or begins there for a cycle degree fifth wave, and I'm expecting primary wave 1 is nearing an end within cycle 5. When primary 1 is over, I will expect a short, well, relatively brief and not particularly deep, but technically a bear market for primary wave 2. We're not quite there yet though. It's getting closer though. Primary wave 1 is subdividing as an impulse with intermediate 1, 2, 3, 4, 5. Intermediate 3 looks longer. It's the chart. It's the scale of the chart. This is a semi-log scale, and the slope of intermediate 1 and 3 makes intermediate 3 look longer, but it's actually not. It's 59.85 points shorter or less than intermediate wave 1. One of the core Elliott Wave rules state a third wave may not be the shortest, so this gives us some information. It tells us that this bull market or bull run for primary 1 needs to end at or before the limit of 5615.34. Within intermediate 5, no second wave correction may move beyond its start below 4278.94. Eventually, when primary 2 arrives, it may not move beyond the start of primary 1 below 2191.86. Let's take a look at the daily chart. Actually, before I go there, the reason why I'm not labelling this a near end to grand supercycle wave 1 is there's just, at the last all-time high, there's no bearish divergence between price and the AD line. There's no strong bearish divergence between price and RSI. I would expect to see quite a lot of bearish divergence developing in a sustained and strong way before the end of grand supercycle wave 1. Those conditions are just not evident yet. There's not enough weakness in this upward movement at the last all-time high to consider this nearly over. So I moved this down 1 degree quite a long time ago. This is just primary 1. And then we'll have 2, 3, 4 and 5, which could take us up right through to 2029 if the 2020s mirror the 1920s, following a global pandemic, a period of expansion and growth in the roaring 20s, and then possibly a big stock market crash, maybe even October 2029. Let's see. Okay, let's take a look at the daily chart. From this high, the end of intermediate 3, is this point here. Here's intermediate 4, a double zigzag, gives us alternation with the single zigzag of intermediate 2, and intermediate 5 nearing an end with minor 1, 2, 3, 4, and now minor wave 5 to end with minute 1, 2, 3, 4, 5. I'm putting a curved arrow on here to show you that I am expecting the S&P may, as it typically does, develop a rounded top. That's pretty normal, and we may continue to see resistance at the upper edge of this trend line. Real quick, let's go back to the weekly chart because this is important. Draw the trend line from 1 to 3, place a copy on 2, copy it over to your daily charts, and look out for resistance again. It perfectly worked. At this point here, it may again work as intermediate 5 comes to an end. The next target, which could possibly even be a bit high, is 4777. Were minor 5 only to reach equality in length with minor 1, that would be too short. And so the next target is for it to reach 1.618, the length of 1 at 4777. This is how I approach these targets. As we approach each target, I will look to see, is the structure complete? Is there any technical evidence for a high possibly being in place? If the structure is incomplete, or price just keeps on going, or if there's no technical evidence for a sustainable high, then attention turns to the higher target, and so on. Within intermediate 5, minor 4 may not move into wave 1 price territory below 4369.23. At the weekly chart level, this is an alternate. It considers the possibility, what if primary wave 1 was over at this high? But at this high, there was zero divergence between breadth and price. And normally, There is at least some bearish divergence at a sustainable high and a change into an actual fully fledged bear market. There are only 3 examples in the last 100 years of a bear market beginning after zero divergence between price and breadth, and as measured by the AD line, 1946, 1976, and February 2020. And so this could be the 4th instance in 100 years, but the odds are really low. So the probability is low. This wave count has a low probability. It's presented as a what if. I wish I had had something like this in February 2020, and I don't want to be left out again. If primary 2 arrives, and eventually, well, sooner rather than later now, it's probably going to arrive. When it does, I will expect it to meet the technical definition of a bear market. If primary 1 was over here, the target for support for primary 2 would be the 0.618 Fibonacci ratio at 3157.04. It would most likely last several months and most likely subdivide as a zigzag. Oh, just before we go, in order for any confidence whatsoever in this very bearish wave count, we need to see 2 things on this chart. We need to see this trend line breached, well, at the daily chart level, with a full daily candlestick of downward movement below and not touching the trend line. That's how I define a breach. And then we need to see a new low below 4278.94. Neither of those things in place, we cannot have confidence in this bearish wave count. Here's the lower edge of the channel at the daily chart level. I need a breach at the daily chart level, so that's a fair way away, and it's a little ways to wait for sure, but it's a bear market and it's got a long way to go eventually when it arrives, but I don't think it's here yet. One of the reasons why I will continue to publish it though is, interestingly, this upward movement here absolutely perfectly found resistance at the upper edge of this Elliott channel, which I've copied over from the weekly chart, and that's where I'd expect intermediate 5 to end. So what if that was the end of intermediate 5 perfectly at the Elliott channel, exactly as Elliott described? Let's consider this possibility. Within primary wave 2 though, no second wave correction may move beyond its start above 4718.50. A new all-time high by any amount at any time frame, even a fraction of a point on a tick chart, is enough to invalidate this wave count because the rule is absolute. Okay, let's take a look at classic analysis now. At the weekly chart level, an upward week this week, a higher high, higher low, a little bit of support from volume. The last signal from on-balance volume was bullish, broke above resistance, testing support, moving up and away with price. RSI is overbought, but there's no bearish divergence between price and RSI at the weekly chart level. If we're moving into a fully fledged bear market, I really would expect to see some bearish divergence develop here. There's just none. ADX is indicating an upward trend in a relatively early stage. This is very bullish from ADX. When ADX indicates a trend, we use RSI, not stochastics, because stochastics, when this market trends, particularly a bullish trend, can remain overbought for a very long time. ATR flattening off as price moves higher, normal behaviour. At the daily chart level, this downward pullback may be a resolution for this bearish engulfing candlestick pattern. Now we're getting some upward movement this week, and overall volume looks to be increasing. It's not actually as clear as this though. This session, down volume actually dominated. It was an outside session closing green, so that session was actually bearish, but overall some increase in volume as price moves higher. If we see another pullback, look for support at 4625 in the first instance. No signal from on-balance volume this week. The moving average situation is full bore bullish. The short is above the mid, is above the long. They are all positively sloped. Price is above all 3. This is a normal look for a bull market, not a bear market, not even a little. On-balance volume, no signal. The support line has a little bit of significance, not much. The resistance line a little bit more. ADX is ever so slightly declining at the daily chart level at the end of Friday. If we see an upward session on Monday, it may again indicate an upward trend. It's got a fair way to go before that trend could be extreme, but at Friday's session, no clear trend. It's these red candlesticks interfering with this, or muddying this signal from ADX. It's based on a 14-day average here, so it's a lagging indicator. RSI is in neutral territory. Plenty of room for this upward trend to continue before these two get extreme. There is obviously an upward trend, a series of higher highs and higher lows. Stochastics overbought, but only just, and ATR declining. Now, what about breadth and volatility? Because it's breadth where we're really starting to see some warning signals. This week, the AD line has declined, prices moved a little bit higher. When we look under the hood here and we look at mid and small caps, they've had quite a strong downward end to this week. They are showing weakness now. That's exactly what I would expect to see for the final fifth wave to end a bull market. So this is starting to shape up as expected. It can develop further before that bull market switches to bear. Not quite there yet, but the warning signs are getting louder. And there's a growing, stronger developing cluster of bearish divergence between price and the AD line at the daily chart level. On Friday, price moved higher, the AD line moved lower. That's happened a couple of other times this week, 3 times this week that happened. This is bearish. The AD line is making a new short-term swing low very strongly. Price is not. Again, bearish divergence. At this all-time high here, here's the all-time high for price, here's the all-time high for the AD line. There is no bearish divergence. Now, there are only 3 bear markets in the last 100 years which have occurred after zero bearish divergence: 1946, 1976, and February 2020. Only 3. If the alternate wave count is correct, this would be the 4th time in 100 years. The odds of that are really low. I will publish it because it is possible. Low probability doesn't mean no probability, but I do have to judge it as low probability. But I will continue to publish it for you because I wish I had done so in February 2020, and I do not want to be left short again. What about inverted VIX as a measure of volatility? Price has moved higher this week, inverted VIX has moved lower. We've now got 3 weekly instances in the last few weeks of single week instances of bearish divergence, a growing cluster of short-term bearish divergence. This week, VVIX has made a very short-term swing high, VIX has not. The volatility of VIX is elevated for the short term. This is bearish for price. At the daily chart level, inverted VIX has moved lower on Friday, price has moved higher, another instance of bearish divergence here. No bearish divergence for the very short term at the daily chart level between between VIX and VVIX. That's all for me at the end of the week with your S&P analysis. I hope that all our members are having a most fabulous weekend.